Okay, thank you very much. It's a great honour to be here to talk about the CRUX UK Special Situations Fund. The fund is 2.5 years old and will be three on the 1st of October. I think it's fair to say for special situations investing in the UK, for about the first 2 years, it was really quite difficult because the dominant strategy seemed to be for most people to be investing away from domestic UK assets and investing in some of the mega cap stocks. Now, smaller caps, small cap funds, special situations funds, and smaller funds have one benefit which is that they're very able to invest in smaller and mid cap names. Up until about 9 months ago, we were not so able to benefit from that. But what we've seen, certainly in the last year, and certainly subsequent to the Brexit trade deal, is we have a much, much better environment where we're really doing well from investing in small and mid-cap names. So here is the fund. It's a UK Special Situations Fund. It's got a multi-cap approach, roughly 25% in large cap names, 4 or 5 names. It's quite difficult to find real high conviction names in the large cap arena. We've got 5 or 6 names there. 40% of the fund in mid-cap names between 500 million and 3 billion, and then about 25 to 30 names in small cap. And that's where the performance in the bottom right has predominantly come from. We've done very well in healthcare and technology names, and also in recovery names in the last year. In terms of what we're looking for, style-wise, we're looking for companies that have value and momentum. So we're looking for growth at a reasonable price, or value with positive drivers. So many people will see growth and value as opposing things. I think growth is what goes on in a company, and value relates to what you pay for a business. The fund will do well under unlocked scenarios, do well when we have positive economic growth. The beta of the fund, even with 5% cash, which it's had for the last year, is about 1.4. It is a concentrated fund. We're currently at about 47 holdings. And the fund size, we've just gone through 50 million. And thank you so much for those people that have continued to back us to do that. We're seeing quite a lot of interest in the UK and more money coming in. And clearly, as I say, the performance has been pretty strong. So just to visit why the UK should suddenly be back in vogue, it's become a very cheap market. So the dark green line there is the UK, the black line is rest of the world equities, heavy weighting on the US, of course. The sort of shadow, the grey shadow, is the difference between the two. And what that shows you is the UK going to a 50-year low against rest of the world equities. So when on December the 24th, the UK got a trade deal, however muted, with Europe, this was a very positive development for what is a very cheap market. And we think that this gap can certainly narrow. And roughly half of the difference versus the US is explained by perhaps the greater exposure to technology in the US, but the other half is just pure cheapness, which we think will drive returns over the medium term. So where do we find special situations? What's the fund looking for in terms of a process overview? We're looking for a trinity of revenues, driving profits, and valuations that are low enough for those to drive share prices. So drivers of revenue at the minute, there are plenty of new markets and technologies around. So last year we did very well with a gene therapy company called Maxite, but recently, in recent weeks, I've invested in companies involved with artificial intelligence. There are also companies that have new products in traditional markets. So Cranswick, which I own, is developing into farming chickens. Historically, it's been in pork. Cyclical recovery. So I think right at the minute, there's clearly going to be really good opportunities with the economy improving. And then we can also get involved in transformational incremental acquisitions. Now, it's really important, not all revenue is created the same. So it's really nice if companies have high gross margins, which means when revenues grow, more of it drops through the profits, and you can compound away and reinvest in the business and create multi-year winners. And it's really important that when you find a company that's growing revenues and profits, you're buying it cheap enough that there's upside when that occurs. And that's great news that the UK is starting low and that small and mid caps were disproportionately knocked over the last 2 to 3 years. So I have an example. Murphy's Law would tell us that this is probably not going to be the best performer over the next year, but it's very typical of how we invest. So the company is Inspecs. It floated in February of last year. It makes frames and lenses for eyewear. The gentleman there below owns 20% of the business, so he's a co-investor, and that's something that's really important to us. It has growth, so the population is aging, people are watching more screens, 6 to 8% revenue growth. Anybody that's bought a pair of glasses recently knows it's not a cheap experience. Lots of margin for the opticians, for the manufacturers. This company has high gross margins, good cash generation, and good return on capital. It's a special situation because it's just bought a very interesting business. Its primary target in November of last year. It got it for a better price because of the lockdown that occurred. And central to this is that there are very significant synergies in manufacturing, distribution, and overheads, which I don't believe are in the numbers and that can drive the share price over the next 2 to 5 year period. So just in the nature of quickfire, where we're different to other sort of special situations funds, we're a high active share fund, which basically means that what we do is very different to the indices. You could blend us with an index if you wanted. We are predominantly mid and small cap. So 2/3 of the fund would be in the mid and small cap area. That's something I've been doing for 29 years. I see a company a day. And of those 250 companies a year that I see, roughly 40% of them are kind of deals. They're very interesting at the moment. You may have refinancings, companies like Inspecs buying cheap acquisitions. And then another factor that I think is a differentiator, I've historically made really good returns in healthcare and software, and that's an area that I focus on, not least because they are predisposed to growth and return on capital, which are process favors. And then just like with Inspecs, where the manager of that company owns a lot of the business, myself and my colleagues at CRUX have a significant interest in the CRUX UK Special Situations Fund. So we're talking about co-investment. And finally, the pickup that we've seen in the UK in the last year and interest in mid and small caps has really helped us. It's only really that the UK has lost its pariah state since sort of December the 24th. We're starting to see more interest in the UK. That's the top-down view. I launched a fund in my previous workplace, Legal & General, which was very, very strong. And when there was a recovery, it certainly reinvigorated small and mid caps for a couple of years. I think given that we've only really started on December the 24th, we're really well placed now with the fund going through 50 million. And there's certainly lots of interesting deals that I'm seeing that we're able to take advantage of. And I think that ends the formal, albeit short, presentation.
Thank you very much for that. And thank you for getting it in the time. I know it's a short session today. And we do have a question for you, actually. I'll just bring that up. So should we worry a bit more that the EU-UK trade deal hasn't been properly fixed and could weigh more heavily on businesses?
We should always worry about these things and not be, take it for granted. There will be developments on it, I'm sure. But to date, actually, the messaging we're getting is that for 5 or 6 weeks, it was an issue for companies trading, that those that take products across borders, but that actually now people are getting more used to it.
And I wanted to ask you as well about liquidity on the funds and how you manage that. Obviously, it's always a huge area of interest and concern for investors. What's your sort of philosophy there and process?
So we have a cap on the level of small cap, which is about 35%. I say about because it's currently 30%, but it will be 35% soon due to a vote. So we will not take the non-free FTSE 350, the liquid companies, above 35% of the fund. So there is always plenty of liquidity in the other 65% of the fund.
Okay, and it is a question I've been asking other managers today, but I'm interested in what happened sort of this time last year when the lockdown happened and managers were starting to review their portfolios. What was your approach then, and how were you sort of looking at the companies in there? What sort of happened during that time?
Yeah, well, when the lockdown occurred, we were, it was unexpected, and very much what we were doing is looking at how much liquidity and cash companies had, because it was unforeseen. And when the world changes, we have to change our mind about some things. So we were looking, line by line through the companies, and in a couple of instances, we swapped out companies with similar exposures for other companies with better balance sheets. With hindsight, all of these companies raised their money. We might have been okay staying where we were, but that at the time was the right thing to do.
And in terms of the recovery for this, obviously that's where our thoughts are turning now as lockdown's been opening up. How do you sort of see that path to recovery for the UK, and what are the potential sort of risk areas that you're sort of still keeping an eye out?
So the recovery is in terms of the performance of the businesses, but also for the share prices. So we've seen a marked recovery on a lot of share prices, particularly the very large companies. It gradually filters down into mid and small companies and some of the microcap, which have bigger upside. I suppose if there is another, lockdown, then we might have another reset for a few months. I suppose where we're being cautious is where we've had some extreme profits and we no longer see upside. We have taken some profits in quite a lot of names and moved on to other names there where we think there is the similar sort of upside that there might have been 6 months ago. So yeah, the danger that there could be another lockdown, I suppose, is always there. But I think in the long run, for long run investors, we know that there will be a new normal at some point.
I know you mentioned in the presentation there about the changes in clients' attitude towards the UK, obviously have been extremely unloved, and we're starting to see that shift there. Maybe you can just say a little bit about what sort of clients are saying to you, and how you've seen that change in approach.
Well, I think there was a gradual direction of travel where people wanted to buy global funds, which in a way was a bit of a proxy for the FANGs and US technology. So I think people thought the UK is old economy and the US is new economy. I think that's true, and I think to some extent we all want to be part of the new economy, but the valuation difference was so huge, and that even allowing for those weightings, the UK is still cheap and there's still a big catch up to be played.
Great. Well, thank you for that. I'm conscious it is a short session today, and that's pretty much our time over. So frees you up for the rest of your day. But thank you for giving us an introduction to the fund there for some of our delegates and on what you're doing. I know they probably know you from being in the industry for such a long time, but that was really helpful and a good introduction there. So thank you for your time.